Credit scores are notorious for being complicated to understand with seemingly contradictory reasons for why your score changes. And worse still, depending on who pulls your credit, your score might vary from person to person. I'm Bradford with the Penny Pinter's Guide to Personal Finance, and I'm going to help break down and help understand how credit scores work so you can take the simple steps needed to be able to increase yours. Let's start out by defining what is a credit score. A credit score is simply a number that is used to evaluate how likely a person is to actually repay a loan. So the higher your number, the more likely that you're actually going to repay the loan, which means you're less of a risk to the lender, which means you're going to get better terms on a loan, which equates to a lower interest rate. On the other hand, a lower credit score means that you are less likely based on your previous actions to actually repay that same loan. So in order to offset their risk, lenders are going to require you to pay a higher interest rate. So that way, if they have enough people that are paying that higher interest rate and some of them don't actually pay back and they default on the loans, they're not going to go completely belly up. And then in some instances, if you have a low enough credit score, lenders are going to decide that you are just too much of a risk based on your previous payment history, and they're not going to be willing to give you a loan at all. So how is a credit score actually calculated? Now, to actually answer that question, we have to ask another one first, and that is, which credit score are you talking about? Now, a lot of people don't know this, but there are actually a variety of different credit score models out there that are all going to come up with a slightly different number depending on which functions and which categories that they're actually using to plug into their algorithm. Now, the most widely used sources that most people are going to see are going to be either the FICO score or the VantageScore 3.0. Now, the FICO score is the oldest and most widely used credit score that's out there, so we'll talk about that one first. Created in 1989 by the Fair Isaac Corporation, FICO scores are used by over 90% of lenders when they're just trying to decide what the credit worthiness of an individual is. So when it comes time to open up a new credit card or apply for a mortgage, this is going to be the credit score that is most likely going to matter the most to your lender. Now, the nice thing is that FICO actually publishes what exact categories they use to calculate your score, even if the exact algorithm isn't made public. Now, when it comes to modeling the FICO score, there are going to be 5 categories that you're going to care about. The largest category, coming in at 35% of your total score, is going to be payment history. And I think this makes sense because the biggest thing that a lender is trying to decide when they're deciding whether or not to give you a loan is how likely are you to actually pay that loan back. And so they're going to want to look at your previous payment history. And if you've done a good job of paying in full on time every single month, they're going to give you a higher score, which means you're less of a risk. On the other hand, if you've had several missed payments or late payments, that means they're going to be less likely to get the full money that they initially lended you back in the time frame that they have allotted, which is going to give you a lower score in turn. And the second category, that's going to come in at 30% of your total score, and that's going to be amounts owed. And this category is comprised of what are the various different types of debts that you have. Now, in general, the larger the amount of debts that you have means that if you get a new source of debt, then you're going to be focused on putting your income towards a variety of different sources, and any single individual one is going to be less likely to be repaid in full. Now, just because you have debt, whether it's a mortgage, a student loan, an auto loan, whatever it is, that isn't necessarily going to hurt you. You can definitely have loans like I did. I had a loan when I graduated the academy, but that didn't hurt my credit score. Actually having that loan and paying it on time every single month actually helped raise my score over time. Now, another component that's going to go into the amounts owed, according to FICO's own website, is that you're going to be your credit utilization rate. That is, what is the total percent of credit that you're actually using on an average basis compared to the total amount of credit that you have available to you. Let's say you have a credit card that has a credit limit of $10,000, and on a month-to-month basis, you're averaging $2,000 of spending on that card. So that means you're going to take 2,000 divided by 10,000, and then that's going to give you a credit utilization rate of 20%. And the lower you're able to actually keep your credit utilization rate, the better your score will be. And the reasoning for this is from a lender's perspective, is if you have and you're coming close to your total credit limit, or if you're maxing out your cards on a regular basis, how it looks to them is that you're probably in a tighter financial position because you're having to rely on the credit that's available to you instead of being able to have a larger credit limit in the first place. And then next up, with FICO scores coming at 15% of your total score, is going to be your credit history. Now, in this one, the longer your total credit history, the better for you. So yes, if you are just getting into credit, you're opening up your first credit card, or if you don't have any credit history and you're trying to get a mortgage, you're going to have a much harder time because they don't have a history to be able to predict what your future actions are going to be like. So in this situation, the longer the history that you're able to maintain, the better for your score moving forward. And then the last 2 categories coming in at 10% each are going to be your new credit and then your credit mix. With regards to new credit, that's just how many inquiries do you have in terms of how many new credit cards you have, what other sorts of loans have you applied for and been accepted for. Now, this one, it really only has an effective period of 24 months. So if you apply for a credit card in 2020, when 2022 comes around, that inquiry is going to drop off your score and it'll be like you didn't have applied for that one in the first place. And at that point, it's actually going to be working towards you by increasing your total length of credit history. Now, while this will have an impact on your score for a total of 24 months, in effect, it's really only going to impact you during the first 12 months after you actually open up that new source of credit. And after that, it's going to continue to dwindle down until it no longer affects you after the 24-month period. Now, with regards to the credit mix, they just want to know what is your various types of credit that you actually have. Do you have a student loan, an auto loan, a mortgage, credit cards, a home equity line of credit? They're just looking at what are the various sources of credit that you have, and then they place a higher or lower risk based on what that actual spread is going to be. But I wouldn't worry about this one because this one's not as easy to actually plan and incorporate into your strategy to raise your score. Just know that this is a factor that will affect you. Now, after FICO scores, the next most widely used credit score model is going to be the VantageScore 3.0. This one was created back in 2006 by the big three credit bureaus, Equifax, Experian, and TransUnion, which, by the way, these three bureaus are the ones that actually go and take all of the data for all the various consumers in the United States, and that is where your credit report is actually going to come from. So if you want to know what is actually on your credit report, these three bureaus are required by law to provide them to you at least once per year if you ask. Now, I've provided a link down in the description down below, so that way you can actually access them for free instead of paying some other entity to request them on your behalf. Now, this model, like the FICO score model, does publish what are the various categories that they actually use to calculate your score. Unfortunately, I don't think this one is quite as transparent because they don't say what are the exact percentages for each of the categories. Instead, they just break down in their list of the 6 categories they have what is the most influential all the way down to what is the least influential category on your score. The first category that is going to be the most influential per their website, and that's going to be what is your payment history. Very similar to the FICO score, they want to know how often have you paid on time, did you have any late payments, or did you have any partial payments where you didn't meet whatever the minimum required payment was. The next most influential category is going to be age and type of credit. Now, this is going to be how long have you actually had your credit history. And then again, they're looking at what are your various types of credit that you have, whether it's the student loan and auto loan, HELOC. And then coming in as number 3 for the Vantage score is going to be your credit utilization rate. Same principle as what I talked about underneath the FICO score model. They want to know what percentage of your total credit limit are you using on a month-to-month basis. And then getting towards the least influential of the 3 categories that they have, they're going to talk about what are your total balances and debt that you have. Similar again to the FICO score, what is the total amount of debt that you're carrying, whether it is a revolving credit like a credit card, or it's something that you're paying down with an amortization schedule like a mortgage. And then the last 2 categories have the least impact on your score is going to be the new inquiries that you have, just like FICO. What are the new inquiries that you've opened, regardless of whether it's a new credit card or if you got a new mortgage. And then the last category, which is going to be the least influential out of all the 6, is going to be what is your total credit limit. Now the higher your total credit limit, the better your score will be with the VantageScore 3.0, and the lower your total credit limit, the lower your score will be. Now that we know how our scores are calculated with the FICO score model as well as the VantageScore 3.0, at least more or less, how do you actually go about raising your credit score? The first thing I want to foot stop here is absolutely do not go to a credit repair company. The reasoning for this is they only have one single legal method to actually help you raise your score, and that's by writing to the 3 credit bureaus on your behalf and having something that is on your credit report that is erroneous, having it removed to increase your credit score. But aside from that, which you can just do for yourself with only the cost of a postage stamp to actually write to the bureau itself, other than that, oftentimes they're just going to straight up scam you out of your money and not help you do anything at all, whether you're paying for a service, trying to lead the legalese of the contract, and not understanding that basically you're paying them to do absolutely nothing. And then the other avenue they have, which is actually highly illegal, is going to be writing to the bureaus on your behalf and then finding some piece of information on there that is lowering your score, but is actually legitimate because it did happen, and they request that it be removed. And if that actually happens, you could definitely be in some trouble as well as the company if you get caught. The bottom line there is just don't use credit repair companies because while it's going to take some time, there's no short, quick fix to actually raise your score. But the good thing is that all these methods are relatively simple and most anyone can actually just apply them in their daily life and raise their score over time. So the first one is going to be making sure with all of your loans, make sure you're getting your monthly payments on time in full every single month. That is going to be the single biggest thing that is going to help you raise your score over time. The next tip deals with your credit utilization rate. I mentioned earlier, the lower your credit utilization rate, the better it looks to lenders. the good rule of thumb to use is try to keep your credit utilization below 30%. Now, if you have to go above that from time to time, which I've certainly done with some big trips that I used for my family, I had the cash, I wanted to get the points, so I got a pretty good chunk of credit used on a various credit card, and then I was able to pay that off. So if you do these on like one-time things and you're not continuously coming close to your total credit limit, it's not going to hurt you. What you want to focus on is what is the average that you're doing on a month-to-month basis, and you want to try to keep that as low as possible. And the other thing that you can do to actually help do that is that over time, I think once a year, is requesting a credit limit increase or applying for a new source of credit to increase your total credit limit that you have available to you. Now, the caveat for that strategy of opening up new sources of credit is you don't want to open up a bunch of different sources of credit all within a short period of time. The reasoning for this is from the lender's perspective. If they see a bunch of different sources of credit, whether you open up like 5 to 10 credit cards all within just a month, they're going to be seeing some major red flags, because to them, whether or not you actually do this, they're worried that you are getting all these new sources of credit so that way you can max them all out and skip town and not pay them back. So if you're looking to open up some new credit cards to try to take advantage of some intro offers or whatever it is, try to spread that out over time. Now, again, if you want to open 1 or 2 cards within a short period of time, that's not going to hurt you. Just don't go buck wild and open up a bunch of them at the same time. So in reality, credit scores are actually pretty simple once you understand how they work. And if you're trying to go about actually raising your credit score, check out some of our credit card reviews that we have in this playlist right there. I want to thank you for watching with me today. And please remember, from your first penny to your first million, we're here to help.